Assalamualaikum and hello everyone. Welcome back to my channel, and this video is on the preparation of a consolidated financial statement. But before we could do that, our focus today is to discuss on one of the intra-group transaction, which is under the group consolidation issues. Specifically today, we'll be dealing with intra-group sale of non-current asset, intra-group sale or intra-group disposal of non-current asset. I will be focusing on non-current depreciable asset, looking at how do we eliminate the unrealized profits out of this intra-group sale, which is an intercompany transaction, and also doing the adjustment for depreciation. Okay, so the reference for this slides, if you want detail, please refer to the textbook, which is the Company and Group Financial Reporting by Jane Lazar, published in 2018. You can refer to chapter 12, page 437 to page 443, specifically note 12.2 at page 437. However, for the purpose of this discussion, I'm ignoring the deferred tax. There will be two situations here where when we talk about intra-group transaction, before this, intra-group transaction may deal with intra-group sale of inventories, but for today, we're going to focus on the intra-group sale of non-current asset, or here I'm using NCA. So there are two situations that I'll be focusing here, explaining to you the scenario first before we proceed with the second video, which is on the illustration. But the first scenario here is what happens if the parent is the one that is selling the non-current asset and that it is at a profit to the subsidiary. Let's say a parent company, which is the seller, is selling the non-current depreciable asset to the subsidiary. So now the subsidiary is the buyer, right? And what you need to do is in the books of the parent or during consolidation, the seller need to compare between the selling price of the asset with the carrying value to the point of view of the seller. Here our seller is parent. And if the selling price is greater than the carrying value, that is meaning to say that the seller or the parent has charged the profit on that transaction. And for group consolidation purpose, this profit shouldn't be realized. So what we need to do is we need to go and remove that profit, and we need to provide the provision for unrealized profit, because this is an intra-group transaction. And the intra-group transaction, in the preparation of consolidated financial statement, before we can prepare, we need to know what to adjust. And here the issue is on intra-group sale of non-current assets. So we need to eliminate or cancel off in the retained profit of the seller, and in the case here is the parent, to reflect the carrying value of the asset to the group. So you need one consolidation adjustment here, which is to eliminate that unrealized profits on the intra-group sale of non-current asset. So the retained profit that will be adjusted is the retained profit of the seller, or here the seller is the parent company. So you're going to adjust the consolidated retained profit. And let's say the amount is 200. The profit here is 200. So that 200 will be removed. And that will be adjusted against or credited against the non-current asset. And the non-current asset here will refer to the non-current asset on which who is the buyer. So the buyer here is the subsidiary. That is one adjustment that needs to be done if that is the case where parent is the seller and the subsidiary is the buyer. In the buyer's situation, there has been adjustment, there has been depreciation that have been charged from the date they purchased the PPE or maybe non-current asset from the seller. So adjustment for depreciation are also needed here, meaning to say that if you adjust for the retained profit, you also need to do adjustment for the depreciation, which relates from the date of disposal to the current financial year end for the depreciable non-current asset that was being disposed. So we need to do and make adjustment, and this depreciation of the buyer that has been over provided. Why has been over provided? Because it was sold at a profit, right? Has been sold at a profit. So buyer is charging the depreciation at a higher amount, whereas the seller is still charging it at a slightly different amount. And therefore, it must be adjusted against the unrealized profit in the retained profits of the seller. So what need to be done is the depreciation that has been over provided. We'll have to do some calculation using some illustration. This is not the figure, but you will have to look at what are the depreciation method, either the straight line method, reducing balance method, or if you adopt straight line method, let's say you may also need to look at the percentage on cost, or either it is using the remaining useful life. So that depreciation that have been provided by the buyer, which is the subsidiary, has been over provided. So we are going to go and reduce the depreciation of the asset, where that will be adjusted by reducing the retained profit. Whose retained profit? Is the retained profit of the seller. And you are going to go and increase or going to reduce the depreciation, right? By crediting the retained profit, and also will be adjusted against the accumulated depreciation account if the asset is shown at cost. However, if there is no information on the cost of the asset disposed, right, or the cost of the asset here, let's say a PPE, you are going to go and adjust directly to the non-current asset that was involved at the carrying value by debiting the non-current asset, right? Okay, so in that will involve the non-current asset of the buyer, but most importantly is that the adjustment in the retained profits, which will involve the preparation of the schedule of group retained profit, will be in the seller's column, and the seller here is the parent itself, or it will be adjusted in the group retained profit or the consolidated retained profit. And for your information, should you involve with non-current, non-depreciable asset, this adjustment is not needed, because we do not need any depreciation for asset like land, or maybe for items which are non-depreciable. Okay. The next one is similar case, where this one is what happened if the subsidiary is the seller, and we will be looking into in an illustration as well on what happened if the subsidiary is the seller that is selling the non-current asset to the parent. Now parent is the buyer. So therefore, what we need to do is the same thing. We will be comparing the selling price with the carrying value to check what is the profit or the gain to the point of view of the seller. Remember, the seller is the subsidiary. And this is an unrealized profit. You have already charged profit before this, and now you need to go and eliminate this unrealized profit, because that is an intercompany transaction where it will be adjusted in the retained profit of the seller. Now it goes to the subsidiary. You need to go and eliminate, because the consolidated statement of financial position or the consolidated financial statement will not report any intra-group transaction that gives rise to profit here. So the profit that were earlier realized now has to be removed or eliminated. So it will be debited to the retained profit of the seller, depending on who is the seller. Here is the retained profit of the subsidiary, and it will be credited against the non-current asset of the buyer, depending on what is the current asset being disposed, and the buyer here is parent. The same thing as I mentioned earlier, adjustment need to be done for the depreciation, and here the buyer is the parent. So the depreciation that has been over provided by the buyer based on the selling price, right, should now be adjusted against the unrealized profit in the retained profits of the seller. It is the buyer depreciation that has been overprovided, but it is being adjusted in the retained profit of the seller. And this will be done in the schedule of the group reserve and the non-controlling interest before we can proceed on preparing the consolidated statement of financial position. So the accumulated depreciation will be adjusted if the asset is shown at cost. Alternatively, it is not shown at cost. You will be adjusting the non-current asset that is involved at the carrying value. And that will involve the adjusting the buyer's asset. Now the buyer is the parent company. And it will be adjusted again the retained profit of the seller. So here what you can see is that retained profit of the seller means is the same place where you adjust for the unrealized profit is also the place that you will be adjusting for the depreciation that has been overcharged or has been overprovided. Okay, that's it for this session. I'll be showing you the illustration for both situations using an example. So catch me in my next video. Thank you for watching. If you like the video, just hit the like button and kindly share the video if you think this benefits you. It might also benefit others. With that, I thank you for watching. I'll see you when I will see you. Assalamualaikum and have a nice day ahead.